What's up, audit fans? Dr. Amanda here with our very last video about audit in 2019. And today I was spoilt for choice in terms of what I'm going to talk about. We've got new ISA 315 about understanding the client and identifying significant risks. We have the ASIC inspection report, the Australian regulators inspection report on audit firms and all the juicy details in there. But I've chosen today to talk about the findings and the recommendations from the Brydon Report, the latest report out of the UK on audit firms and audit quality. They've recommended 14 potential changes to audits, the audit industry, audit firms, audit reporting. I'm not going to go through all of them today, but I'm going to pick some of the most controversial and topical ones to discuss. So let's get into it. Welcome back to all my regular subscribers. Hi if you're new. My regular subscribers will notice that I'm probably a bit further away from the camera than normal because we have merch. So a few people have asked me about merch. There's now some stuff on the merchandise shelf within YouTube, so you can go check out those. If you have any other ideas for merchandise you'd like to see, please let me know and you can order those through Teespring. Now, for those who are new to my channel, welcome. My name's Amanda. I'm really passionate about audit. I teach audit to undergraduates. I've got this YouTube channel. I'm a guest speaker and a keynote speaker in audit. So I have a lot of experience in the field. I came from practice before moving into academia, and I'm really passionate about encouraging people and into the audit profession. I still think it's a great profession, even with all the controversy and things we're going to talk about today. The Brydon Report recommends 14 key changes to audit. The audit profession, how the profession is structured, reporting, firms' responsibilities as well. And it's really important and interesting that in the recommendations, they've also included changes in terms of corporate governance and companies, because remember, audit is part of a larger scheme of corporate governance. It's shareholders, it's executives, it's the audit committee, it's the auditors, and it's regulators all working together to try and protect shareholder interests and serve the public good. So what are some of the key changes that have come about from the Brydon Report? Well, the first one I'm going to talk about is a change in the definition of what exactly is an audit. So it now says, or what they recommend from the report, is that the purpose of an audit is to help establish and maintain deserved confidence in a company, in its directors and the information for which they have responsibility to report on, including the financial statements. So what is really different here is that it's talking about reporting generally, and then it says including financial statements. So this really broadens the scope of audit. Typically we think about audit from that financial statement perspective. Now, it's interesting that we do see this widening because there are things like integrated reporting and extended external reporting, which is really about providing assurance on other things besides the financial statements. That could be greenhouse gas emissions, the amount of recycling, it could be around modern slavery requirements, it could be around a whole range of different things. It's really interesting that it's now talking about giving people confidence in the company, in the directors, and in the information. Because in the past, we've really just focused on giving confidence to the information in the financial statements. We're giving that information credibility. We don't really rate management. We don't say, oh, the directors are doing a good job or the executives are doing a good job. So it's interesting here that it says that we're trying to increase the confidence, well, part of an audit is to increase the confidence of the directors. And really, company directors should be evaluated by their shareholders based on their actions. I don't really know how, as auditors, we're going to improve that confidence in directors and executives within the company. I guess if we're reporting on their control over financial statements, that might be okay, but we're not saying thumbs up or thumbs down to the quality of their decision making. So that's something that's interesting. And I'm wondering if that's actually going to cause a bit more confusion within the marketplace rather than this very current technical term that we have around accounting. The second recommendation that I want to talk about is the Brydon Report's recommendation to create a formal profession for auditors. Now you might think, hang on a second, don't we already have one of those? And we sort of do. Auditors fall under the general umbrella of the accounting profession. And there's been a lot of discussion on Twitter this week. Tom Ravlic notably said something along the lines of, well, we already have a profession for audit that's within accounting. And if you go to the Code of Ethics, you'll notice that the Code of Ethics has general principles for all accountants about being objective and honest and remaining confidential and having the right skill set. Then you'll notice that there's actually a section of the code dedicated to accountants in practice, in commerce. And then you'll notice that there's a whole section of the code also dedicated to the ethics and professional standards and judgment and decision making associated with accountants who are auditors. At this stage, I'm not convinced that having a profession specifically for auditors is really the way to go. Maybe we think about additional certifications for auditors. I know that internal auditors have their own certification in the US. Management accountants have a certification. So maybe we think about additional certifications for auditors, but I don't know whether joining a professional association for auditors would be the right way to go. We might think about beefing up the Code of Ethics in the section for auditors to go beyond just independence and maybe extend that into judgment and decision making. But I'm not sure about this idea of creating a profession specifically for us. I quite like being part of the broader accounting profession. It means that the skill sets I have, yes, are related to audit, but could help people from a management accounting perspective, from a valuation perspective. It's a really broad skill set. And I think we can have specializations within that, but I'm not sure whether we need our own specific profession. One of the recommendations that I wanted to bring to light and talk about is not one that's probably going to be very controversial, and that's the idea of audit committees having their own budget for doing the audit and then negotiating the audit engagement, the client fee, the contract with the auditor directly. That makes absolute total sense. In a lot of circumstances, the audit committee already is responsible for discussions, key discussions, and leading the relationship with the auditor. Now, technically, the auditor is evaluating management, and they're doing that on behalf of shareholders, and the representatives of shareholders are the audit committee. So that makes 100% total sense. What I hear practically is quite often in large firms, executives, so CEO, CFO, the executive suite will recommend a list of auditors to the audit committee, and they will make some choices. The audit committee will make those choices. This, I guess, more clearly delineates who selects the auditor, the negotiation process. But I don't think that's really that controversial, but I think it will mean that audit committee members definitely need to make sure that you understand audits, audit pricing, and the fact that pricing of audits reflects the risk and internal controls of the client. So I think this is a good thing moving forward. The Brydon Report also recommends that audit committee chairs, so the independent director who oversees the audit committee, and the auditor also be questioned or able to be questioned at the annual general meeting. Here in Australia, that's been around for a while, so that's nothing new. It's nothing terribly controversial. Certainly in the case here in Australia, we certainly think that the banks, after the Royal Commission and all of the fallout from that, I think their auditors will probably get a bit of a grilling, but I think that's reasonable to expect. We produce an opinion that is relied upon by people, by shareholders. So I think it's reasonable to expect that shareholders should be able to ask us questions. Now, there is a little bit of a risk in that. People might not understand what an audit is about and ask questions that really expect more from auditors than what we actually do, which means that when auditors are being questioned about audits, we need to make sure that we're trying to close the expectation gap, that we're doing as much as we can to educate our shareholders about what an audit is, but also what an audit is not. An audit is not a check on management's decision-making ability. We're not saying whether they're making good or bad decisions. It's also not a fraud investigation. So we're not designing audits to search for fraud. Forensic investigations have a very different nature and style and take because of their very nature. So we need to make sure that if auditors and audit committees are being questioned by shareholders, they have a really good understanding of what we do. And that's important for the profession. The profession here needs to make sure that we're doing as much as we can to educate the shareholders of all of our clients. Now, for those of you studying audit, you will know that the legal liability for auditors essentially exists to our shareholders. We conduct our audit and we prepare our audit report for the shareholders of the client. We don't produce it for other parties, what we call third parties. And we really only have liability to third parties when we have proximity. And you can check out some of my other videos on explaining the concept of proximity, but there really needs to be a real relationship. The auditor needs to encourage or entice or induce that third party to rely on the audited financial statements and our audit opinion in making their decisions. So in the Brydon Report, they say we should consider other stakeholders when it comes to who could be using our audit report. Now, that might be absolutely fine to consider these other stakeholders, but the risk becomes if we change the principles of what audit is all about, and the Brydon Report talks about creating principles of corporate auditing, then if those principles say we now must actively consider the use of our audit report and the financial statements by people other than shareholders, then the question becomes, do we become liable to those external parties, those other stakeholders? Does that increase our legal liability? Because then if an other stakeholder relies on the audit opinion, something goes wrong, we've failed in our duty of care as an auditor, we've been negligent, then that potentially exposes us to a much wider range of legal liability than currently exists. So if you're exposed to more risk of being sued, then how does the audit firm respond to that? Do you increase prices so that you do additional work to cover the additional risk, or because of the risk-reward relationship? Do you try and pick audits where you don't think you're going to have any issues with other stakeholders? There is a big risk in this particular area if expanding the auditor's customer, I guess, or the client that we're thinking of beyond the shareholder actually increases our legal liability. The lawyers certainly are going to have a minefield investigating and unpacking this issue, and I'm sure there'll be lots more to come. Another really interesting section of the Brydon Report is the recommendations related to fraud. Now, we know that the board of directors and executives are those charged with governance. They are the people who are responsible for creating the policies, procedures, and internal control structures to make sure that transactions happen appropriately, that the business is doing everything to achieve their objectives, and to minimize the possibility of fraud. So the recommendation that says there's a new reporting duty to set out the actions that they've taken each year to prevent or detect fraud is really just confirming what we already know. Now, how does that impact on the auditor? Well, ISA 240 says we need to be on the lookout for red flags that might indicate fraud. We very clearly state in an audit that this is not a fraud investigation, and there isn't anything in the Brydon Report that says that we need to be doing extra to, really investigate fraud unless there is a red flag. But it is nice to see that management and those charged with governance are being asked to explain, potentially in their director's report, what they are doing to prevent and detect fraud. Are they implementing new internal controls? Are they evaluating internal controls? Do they have some sort of forensic fraud analytic process happening to try and identify unusual transaction patterns? That could be something linked into audit, because as we move into more data analytics and AI heavy and technology heavy tools and techniques for audit, then those sorts of things might be the sorts of tools that auditors might use as well. So the idea of the live real-time assurance might be some sort of partnership between the client and the audit firm using these systems together to help prevent and detect fraud real-time from a management perspective and then investigate any issues from the audit perspective. What I really thought was interesting about the fraud section of the Brydon Report was also the recommendation that auditors undergo forensic accounting and fraud awareness training. It's really interesting because a lot of the older studies say that, maybe less than 5% of auditors ever find a fraud. I would expect that if we're asking auditors to learn more about forensic accounting and fraud awareness, that certainly would also involve using a lot more analytics and data analytics and AI related tools, as well as understanding the human part. What motivates people? What could be indicators of fraud within organizations? And really, that's still the same thing that ASA and ISA 240 talk about. They talk about the fraud triangle. Is there an incentive or a pressure to commit fraud? Is there an opportunity to commit fraud? And what are attitudes and rationalizations to commit fraud? I think if we keep reinforcing that, that's really great for the profession. The Brydon Report also recommends that in the UK, firms start talking about deficiencies in internal controls. That is, if there's been a major incident where an internal control is broken down, like in the case of Westpac and NAB, where they had tens of millions of transactions that should have been clearly flagged as inappropriate, that clients talk about those and that the board of directors mention those failures in internal controls. And that's not really anything I think that's going to be too different than what we see in the US. In the US, under the Sarbanes-Oxley 404 reporting, American listed companies and dual listed companies and those that have to report under SOX 404 already have to talk about material deficiencies in internal controls. That hasn't caused the sky to fall down there. That we will see, I think, an increase in audit fees if that sort of recommendation is taken on board, because to provide for the auditor, for example, to provide information or assurance on management's report on internal controls, that does take some extra time and some extra work. If you're a UK company that's listed in the US, that's going to be absolutely no increase in cost, really, because you're already paying for that for your US listing for your UK company. We don't currently have that in Australia, so it'll be interesting to see what Australian regulators think about the potential for disclosing information on material deficiencies in internal controls by managers or directors, and then also assuring that by auditors. One area where I'm going to be watching the commentary really, really closely is the area on auditor transparency. Now, audit firms are a big black box. We have no idea what is happening in terms of profit distribution, financial statements, partnership structures, how people are remunerated, etc., because they're not publicly listed companies. They're not public interest entities, so they don't have to produce audited financial statements. Now, all the big firms do release information about their revenues and how those revenues are broken up and costs, etc., but those aren't standardized. So we don't know whether all the firms are reporting on the same thing, whether they're using the same measures, and none of that information is assured. So the information in the Brydon Report about auditor transparency is certainly going to be of interest to audit firms, because they're asking firms to do things like have a clear separation between the team which negotiates the audit fee and then the team which carries out the audit. That sort of makes sense in a way. You don't want the team who's doing the fee negotiation to then have to worry about cutting corners and maintaining profitability. On the other hand, if you're the team who's doing the actual audit, then surely you'd have a really good understanding of what's involved. We do have to be careful, if this comes into play, that the team that's pitching the audit fee has a clear understanding of the complexity of the audit so they can price it appropriately. They don't set the price too low, which may make the audit team feel like they have to cut corners to try and make an audit that's break even or profitable. Now, one of the other things is that audit firms are going to be required to publish the profitability of their work from an audit and the remuneration of their senior statutory auditors and the performance measures around that remuneration. So we have rough estimations about audit firm profitability, and there was always the myth that audit firms on their own, if you just did audits, would not be profitable. However, some information that came to light this year in the Australian Financial Review, reported by Edmund Tadros, indicated that gross margin for audit firms, the big four audit firms, was anywhere between 40 to 80%. 80% gross margin. Then take away overheads, and confidential industry sources told me that, well, on average, audit net margins are 20 to 30%. So realistically, audit firms could stand alone. They could act independently away from tax services, consulting services, and that might be an impetus to hive off audit firms. Now, that's not something that's recommended in the Brydon Report at all. It was recommended in some other reports in the UK. The CMA report recommended, I think, hiving off audit firms into their own sort of separate little section. PwC announced press releases that their audit part in the UK was going to be audit only and not offer anything else. So asking audit firms to talk about profitability and transparency around audits is going to be really interesting. And for researchers, there's a whole heap of research on how audit firms set their fees, premiums for being big firms. All of this greater transparency will also mean that there'll be lots more research around audit fees and audit pricing, which will be good to help inform the share market as well, and investors about, well, how does audit pricing work? Is it just a certain number of hours times a certain rate? Are other things taken into account? One part of the audit transparency section that really got me thinking was a section that said auditors disclose within the audit report the hours spent on each audit by each grade within the audit team. And that is really, really interesting because right now we just see one line that says audit fees X number of dollars. We don't know whether that's a lot of partner time and a little bit of junior time. How much time do juniors spend on this? The other thing that this doesn't take into account is the use of technology. As we use more data analytics, then how does that fit into hours? Do we also need to include line items like hours or dollars or investment or charges related to technology in doing the audit, not just people? Because what we've seen is a shrinking in the number of graduates that audit firms are taking on. That also means that graduates are doing different things than they were doing when I started as an auditor. I did manual calculation checks of printouts of spreadsheets. Now all of that would be done automatically. How do firms report when they have offshore operations? I know that most of the big four firms do have an offshore operation, potentially somewhere in India or in the Philippines, where cheaper labour does things that graduates used to do. How are we going to know whether we're looking at significant numbers of hours done offshore? Is that offshore work the same quality as work done by graduates in country? And how is that all broken down? Again, lots of interesting data that for researchers would really give us an insight into audit processes. That also means, how do we assure that firms are telling us the right thing about how many hours each people are doing? And how will that impact behavioural auditors within firms? If you're worried about having too many partner hours or too many junior hours or not enough junior hours, is that going to be encouraging people to misreport on timesheets, for example? I remember on one audit as a junior, we were told, look, the budget is only for this much. We could only charge so many hours, even though we'd done a lot more than that. We were told to put that other time to admin to fill in our timesheet. So these sorts of measures around transparency and reporting of hours and reporting of profitability, we know this information changes executive and manager behaviour. How will that change auditor behaviour? The very last recommendation I wanted to bring to light was the discussion around professional judgment. And we know that audits are all about professional judgment because there's no right answers in any of these situations. And we know we have the idea of professional skepticism. All right? The idea, if you look up the word skepticism in the dictionary, it says something along the lines of, you have to really convince someone. So it's not easy to convince a skeptic to believe in something. And we're meant to have that professional skepticism, the questioning mind. The Brydon Report actually recommends something that they call professional suspicion. The definition of being suspicious is having or showing a cautious distrust of someone or something. So it says we should still have professional skepticism, the questioning mind, being required to be convinced. We have to be convinced by the evidence. But the idea of professional suspicion is really about distrust. And if you look at the definition of the word suspicion is that we have this innate distrust. So that means as an auditor, if I have professional suspicion, I need to go in there distrusting management, if I go by that just basic original term. This is going to be really interesting for auditors because remember, we have to work with the client to gather the information and the evidence to be able to provide our opinion, to add credibility to the information for shareholders so that they can make the best decision possible. If we have to be suspicious, does that change how we interact with the client? Does that change the sorts of evidence that we need to collect? Do we need to consider more negative evidence as well as confirmatory or positive evidence? Do we have to be able to prove that there's no disconfirmatory evidence to eliminate any suspicion? This is really interesting as a concept, and I'm interested to see how the debate around the idea of professional suspicion and professional skepticism moves forward. So that's it for our last video of the year. Of course, if you're after any of the merchandise, check it out on the merchandise shelf. As always, if you thought the video was useful, I'd really appreciate the thumbs up. Click to subscribe. And if you have any ideas of what you'd like to see in 2020, drop them in the comments. I'm taking ideas and trying to flesh out my video schedule for 2020. I know that there are some things I still need to do. I need to fill out, I think, 3 extra videos within my Standard Explain series. There's a whole lot of other videos coming from my collaboration with the Australian Auditing Standards Board, but I really want to know what you want to hear about in 2020, and I'll do my best to try and make that happen. Have a safe and happy holiday. I'll be enjoying my time with Audit Senior, Audit Junior, Mr. Audit, and my audit dog and the rest of my family, but stay safe and I look forward to seeing you all in 2020. Happy holidays!